Hey everyone, I reference depreciation in a lot of videos, so if you don't know what I'm talking about, this video is for you. So, depreciation, what is this? Well, we often hear about appreciation, what we hope our investments do, and maybe when we're referencing cars, a lot of times we talk about depreciation. What's the difference? Appreciation, like I said, is when something goes up in value. Depreciation is when something goes down in value. Now, from a tax perspective, the depreciation deduction that you get is not actually a real expense most of the time. So this is super important to understand because what it really is it says you've made some big expenditure. So unlike buying, supplies for the office, those usually get consumed pretty quick or have a short, what we call useful life. And so you just take a write-off right away for it. But when it comes to larger purchases, like real estate, you have something that you're buying that's going to last many years. So what depreciation does is it basically is the write-off of that cost over time. So you take whatever the cost is and you divide it by some formula, some amount of years, and you get what your annual write-off is in any given year. Now, the amazing thing about real estate is over a long period of time, it goes up in value generally. But from a tax perspective, you're actually basically treating it as if it's going down in value, which is giving you these deductions that benefit you and reduce your income. So this is really, that's why I call it this fake deduction. It really has no basis in reality. It's just a freebie deduction that you get. And sure, you can get this deduction in other businesses. If you're purchasing large equipment or you're buying cars or you're buying, whatever large expenditure there is. But most of those other items that are not real estate that you're depreciating, they may not go down in the same rate that the IRS says you have to deduct it at, but they are going down in value. So it's really a huge benefit to be able to take a deduction for something that's actually increasing in value. So now I'm going to go into more of how you actually look at different types of property and what it means for your depreciation deductions. Okay, so let's jump into the specifics here. Now I've just laid out 4 different categories, and what these are is basically the IRS has said if your property is in one of these categories, it's going to determine how long you have to take depreciation deductions. Now, I don't know who came up with this or really what the basis is. It's really just numbers that someone made up at the end of the day. It doesn't matter. They have no real basis in what's actually happening to the value of the property most of the time. First, residential, 27.5 years. And this is any type of residential property where people are living there. So this can be a single family home. This could be a duplex. This could be a large apartment complex. Even though, in the real estate world, you may refer to a large apartment complex as commercial. Well, in the depreciation world, residential means someone's living there. That's the bottom line. Commercial is now a business. People are not living there. That type of property has to get depreciated over 39 years, so a lot longer. The next category is what we call land improvements. So these are the items that are not part of the building itself, but they're really operating as part of the building a lot of times. So for example, the parking lot when you pull in, sidewalks, maybe exterior lighting or fencing, things like that are referred to as land improvements. And those are going to take a 15-year depreciable life. The last category we're going to talk about is personal property. So these are items that really you can pick up and move. That's what this is. It's not real property. It's not stuck in place. You don't have to, in order to move it, demolish it or something. So this type of property is going to be 5 years. So think of maybe like your computers or furniture, or when we really get more into breaking things down, the carpeting or other maybe components of the real property. And if you're not sure what I mean by that, check out our video on cost segregation. We'll go into more detail on how you break down different components in a building and what benefits that gives you. Now, one important thing to remember, land is not depreciable. So when you buy real estate, you have to realize that a piece of that is related to the land that the improvements sit on, and then another part of that value is related to the improvements that are on that land. So you have to figure out how much is land because you can't depreciate that. So this is really important to realize. So let's do a quick example on how this depreciation works. And here you can see we're assuming you bought a house for $350,000. And we're going to say that we've determined that of that total cost, $275 relates to our depreciable building. That means the other $75 is the land, which is not depreciable. So how do we figure out what our deduction is? Pretty simple here. We just take our $275 of building value, divide it by the depreciable life in years for residential property, and we come up with $10,000 is our fake deduction every year. So that's kind of a quick and dirty way of how you would calculate depreciation. And of course, if you have different types of components within this, like for example, if you added something outside that was exterior that was considered a land improvement, you'd have to separately calculate the depreciation on that piece. Or if you did a cost segregation study, which again, check out the video if you don't know what that is, then you could potentially break out the different components and get a little more depreciation than that 10,000 number to help your bottom line. Okay, what about exceptions? Because what I've learned, if nothing else, in the tax world is that there's always exceptions. And then there's typically exceptions to the exceptions. So here we have a couple exceptions to your depreciation deduction. And you might hear these around, you know, they've been thrown around a lot. These are a huge piece of figuring out your depreciation. That is bonus depreciation and Section 179 depreciation, which is creatively named after the code section that this is actually comes from. So what does this mean? Bottom line, on a very basic level, is this means you essentially get to write off the full cost of something in the year you acquire it instead of having to take those deductions over time. So this is a huge benefit. So bonus right now, you can write off the 100% of property that qualifies. And generally, the property that qualifies is what's considered personal type property. And there are exceptions. But some of the things you can write off is, you know, if you put in carpeting into a rental property that's new, you can write that off right away. Let's say you put in a new parking lot for your commercial property. That generally can be written off in the year you do it. And then 179 is more for, well, it can be both personal type property, so in a business, like machinery or things like that, sometimes cars that you're using in a business, you can write off in the first year you acquire it. Or it can sometimes fall into the real estate world where you can write off, maybe if it's a commercial property and you have to do tenant improvements, you could write off some of those tenant improvements in the first year instead of taking deductions over 39 years. Or if you want to, for example, now you can write off the cost of new HVAC units, you know, the air conditioning units, which you used to not be able to under 179. And there's some other exceptions in there, but really what this means is just make sure you're checking with your CPA or accountant if you do new, you know, improvements to something, whether you can write those off in the current year. That way you're aware of how it's going to impact you. So that's the basics of depreciation. Be sure to comment down below if you have any questions or you like the video. Give us a thumbs up and we'll see you next time.